Imagine a time when America's economy was like a wild roller coaster, thrilling yet terrifying. The early 1900s brought booms that felt like a dream, but they were always followed by brutal crashes that left people reeling. Picture this: panicked crowds lining the streets, desperate to pull their savings from banks before the vaults ran dry. It was chaos. In 1907, one of those panics nearly toppled the entire financial system. And who did Wall Street turn to? A single man, J.P. Morgan, the private banker. Can you fathom that? The survival of an entire economy resting on the shoulders of one wealthy financier. And that moment was a breaking point. Lawmakers realized America could no longer rely on luck or the whims of a powerful banker. So in 1913, Congress passed the Federal Reserve Act, creating a new central bank designed to stabilize our financial system. But here's the catch. How do you ensure that politicians don't turn the Fed into their personal piggy bank? What if every election cycle, presidents could just order the Fed to slash interest rates? The consequences could be devastating: spiraling inflation, a shaky currency, and a collapse of long-term growth. To protect against this, the Fed was designed with institutional independence. Governors serve 14-year terms, insulated from the electoral cycle. The Federal Open Market Committee makes interest rate decisions free from White House control. Congress sets broad goals: stable prices and maximum employment. But the day-to-day calls? That's left to the Fed itself. History has shown us why this matters. Take the 1970s, for instance. President Nixon pressured Fed Chair Arthur Burns to keep interest rates low, hoping to juice the economy before his re-election. It worked in the short term, but the long term, skyrocketing inflation and stagnant growth, what we now call stagflation. The Fed had to slam the brakes, raising interest rates above 15%, plunging the country into recession just to restore credibility. That painful lesson taught Washington the importance of letting the Fed operate without political meddling. Fast forward to today, what if a Trump administration, or any administration, leaned hard on the Fed, demanding lower interest rates for political gain? Sure, the short-term sugar high might grab headlines, but the long-term damage could be catastrophic. Investors could lose confidence in the Fed's independence. Inflation expectations would surge. The dollar's status as the world's reserve currency, it could be shaken to its core. Legally, the Federal Reserve Act grants the Fed this independence. Courts have recognized its autonomy from the executive branch, but legal text alone isn't enough. The system relies on political norms, presidents respecting boundaries, even when it's inconvenient. But what if those norms collapse? What if political meddling becomes the rule rather than the exception? The Fed risks becoming just another partisan tool. And here's the crux of it. The Fed's independence isn't just a matter for ivory tower economists. It's about your mortgage, your retirement account, your paycheck. It's about ensuring that monetary policy serves the economy's long-term health, not the next election cycle. So the real question isn't just whether the Fed can survive legal attacks on its independence, it's whether our political culture will allow it to thrive. Because once that independence is gone, the trust anchoring our entire financial system could vanish with it. Are we prepared to face that reality? Join the conversation. What do you think? Can we safeguard the Fed's independence in an increasingly polarized world? Let's discuss in the comments below.